So you found a great deal, you made an offer, you're feeling pretty good about everything, debt service coverage ratio is fine, everything looks good, but in the back of your mind, they're thinking, there are some things that I'm a little concerned about that I'm sure that are gonna come out in due diligence, like maybe the seller underestimated the customer concentration, there are other issues, things that they're not make the deal quite perfect, but also is an opportunity for you. So how do you protect yourself against any downside trends post-close when the seller is not engaged? And then you're running the business. So in today's video, I'm going to talk about a couple techniques that we use when we're buying a business to protect yourself against the downside. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. Are you a business owner wanting to expand by buying a business, or a W-2 employee sick and tired of the rat race and want to get out by buying a business? This is your channel. Please subscribe. Don't forget to hit the bell. You'll be notified every Thursday when new content comes out. So in today's video, we're going to talk about 3 topics: seller financing, clawback provisions, and forgivable notes, and how to combine all 3. So seller financing, right now, it's becoming a bigger deal. As you may know from watching my videos and probably following other folks in the space, that when you're getting an SBA loan, things fluctuate. There are new rules that come, new rules that go, new things in place. One of the biggest changes that has happened is that now whenever you're using some of your equity injection, which you're supposed to come up with 10%, 10 equity injection on the purchase price, and the 90% comes from the loan. Well, in the past, the seller could actually help you on with some of the down payment, and then they could be in a 2-year standby. They could get paid right away on that seller note associated with the down payment. Not anymore. So, and the reason for that is because things have happened in the past, and the SBA is overcorrecting. What thing goes up, it comes down, and then it goes up again. Everything fluctuates. But seller financing is becoming a key thing. Now, a lot of sellers understand that dealing with SBA loans is very, very complex, very taxing on them, and very taxing on the buyer. There's the buyer will personal guarantee. The seller will personal guarantee the loan for 2 years if they even have a 1% retention on the loan. So now sellers are thinking, wait a minute, if there are all these hoops that I have to jump through, I may be willing to become the bank myself. So seller financing is becoming more of a tool. Now, it used to be like the standard 10% from the buyer, 10% from the seller note, right? Seller carry, and 80% from the bank. But now things are shifting into more, 5 or 10%, and then 20, 30% from the seller. And sometimes in cases, I've seen it as 20% down from the buyer and 80% from the seller. And these are happening because the sellers are realizing that if they know how to properly secure the note and your personal guarantee, and they can actually have a steady cash flow post-close, and they don't have the tax implications of, recognizing all of the income from the sale of the business at once, which in most cases, it's going to be some ordinary income. They're going to be subject to the highest tax rate. It's a significant event for the seller. So things are changing. So seller notes are becoming more and more useful because as rates go up and things change, sellers realize that in order to get the price that they want, they need to carry some paper. You kind of burden the risk. But when you do seller financing, there comes implications from both the buyer and the sellers. Now, remember what I was telling you at the outset, that sometimes you look at a deal and nothing will ever be, 100%. You don't make a deal on 100%. If a deal was made at 100%, you probably would never see it because it would be sold without even going to the market. It would be totally an off-market deal. But it comes to the market, or it's a pocket lease for a reason. There are some blemishes on the deal, and that the beauty is understanding when you're looking at a business, what is the beauty of it? Where lies the opportunity? And you do a SWOT, strengths, weaknesses, opportunities, and threats on the deal. Anyway, as you're doing your due diligence, as you're making the offer, you may not understand everything that is under the hood that may spell risk for you. For instance, you may have situations in which the seller undervalued or underestimated how much working capital the business needs, or the customer concentration, or other issues that may be there, like some customer dissatisfaction, or some customer service problems, or employee may be willing to walk away, or the employees are just not happy, or many, many things. So as you uncover that during the 30 to 60-day period of due diligence, then you start thinking about how to hedge your bets. Now, how to protect yourself post-close. Now, for instance, I've seen many situations in which 21, 22, 23, and 24 looks great, right? A nice steady progression, 10, 20% year over year growth. And in 2025, revenue decreases and they're negative. Now, the lenders are not gonna like that. The lender places heavy emphasis on the preceding tax year, which is 24 in this case, and they're looking at the interim financials and they better cash flow on both times. If they doesn't, they're gonna start having issues. They're gonna say, hey, look, we don't really like this deal. We want you to reduce the price. Obviously, the reason is to protect you, right? But the seller says, no, and this is the reason why, and they'll give you a story. Whatever the story may be, it may or may not make sense to you. You vet it within your team, which you have a deal team, right? Which is what we talk about all the time. So you're looking at this deal and you can say, you know what? Okay, we're going to compromise. We're going to split the risk in half, and it's going to, I am going to give you what you want, Mr. Seller, right? So let's say the issue is that you recast the valuation and it comes out $200,000 short, and the bank is saying, yeah, it's probably about $200,000 less than what you offered. Now here we are. You either go back to the seller and says, I need you to reduce the price by $200,000, or else, or you may risk losing the deal altogether and walking away because other buyers are ready to pony up the entire asking price of the deal. So what do you do if you really believe in the deal and everybody feels good about it and the risk makes sense and the opportunity outweighs the risk? Then you say, okay, great, I'll give you. We're not going to do a price reduction, but what we're going to do instead is we're going to come up with some type of clawback provision, which means, okay, so you're looking at deals, but the more you look at a deal, the more questions you have, and you don't know who to talk to or validate things like debt service coverage ratio, pre and post debt service cash flow, when to vet the loan, when to have your personal financial statement ready, what about the global debt service coverage ratio, and all those things. Well, I'm sure you have questions. If we have answers, having worked with a community of hundreds of people now inside of a group and closed many deals, we can help you. We'll be happy to give you a complimentary just coaching call to help you where you are in your journey buying a business. Please comment below or send me an email. My email address is upstairs and down here. All right, let's go. Means we're going to put contingencies on that. We're going to create a scenario, and it gives us the right pre-close, before you close, on if something bad happens, then you're going to do something. Clawbacks is you're going to claw back into, you're going to go back into and do something, right, to protect you. Now, so the next topic is a forgivable note. So a clawback provision, it's a term, it's a clause to protect you, which means to be signed off by the seller before you close. So you are actually protecting, you're being very honest and upfront about, hey, if these things happened, then we're gonna do these other things. And the go-to thing that we do, and lenders are quite fine with that because it's not an earnout, it's a forgivable note. So that $200,000 split, you go, okay, I'll give you that. But if the revenue, which is the number one thing that you can measure, is when you're creating a trigger for a clawback provision in a forgivable note, it's gonna be revenue. If revenue decreases, if Q1 over Q1 to 4 between 25 and 24 is down, and you probably think that the trend is going to continue. So if we don't hit the revenue of 2024, then I'm going to forgive X. You're going to forgive X of the note. So the 200,000, it could be the whole 200,000. It could be half of the 200,000. And if the revenue continues, then you're going to forgive all the thing. And everything is preset, so there's no weirdness, right? It's fully understood. Because you want to understand, you want to anticipate all the things that can go wrong, and you want to be able to mitigate against them. Now, one way of doing it, it's revenue, right? And a forgivable note is just that. It's a note that can be forgiven. By the way, you can have multiple seller carry notes in one deal. And so long as you associate what each means. What it could be a 5% seller carry note, which would be on standby for 10 years, so you can come up with a 10% equity. It could be another, amount of money equal to 10% to cover X, and another one to cover X. Now, one of the things that happens is around licensing and key employees, right? So you have a licensing issue, and you think you can overcome it, but you say, you know what? I'm going to take that purchase price and I'm going to mitigate against a potential licensing downside, or I'm not able to get it, so I'm going to have a forgivable clause around that. So I'm going to claw back and figure out a way how to protect myself on that. And key employees. I have seen it where there is maybe one or two employees that are so critical to the business you can't do without. So what do, right? You put a price tag on that key employee in the terms of a forgivable note, whether it's 50, 100, probably no less than 100,000. If that employee walks away in the first 12 months, then that note is forgiving, because the seller has to do whatever it takes to help you retain that employee. And by the way, sellers can stay on for 12 months post-close, no longer than 12 months, consulting you and assisting you to make sure that the transition is smooth, right? Now, typically for the first 60 to 90 days, the seller will stay on at no cost, because that's part of the purchase price. They have agreed to consult with you to help you post-close for 30, 60, 90 days. Beyond that, it's on you. You pay them. Whatever you agree to, there's going to be either a consulting agreement or an employee agreement that is going to go up to 12 months. And their job is to make sure that those contingencies for them to claw back and have a forgivable note are not happening, right? So now you have two of you to worry about this one employee not walking away. Now, how you incent employees to stay on, you can actually give them an employee agreement with some type of upside for them to stay on. It happens quite a bit. It happens quite a bit inside of professional services like engineering firms, accounting firms, law firms, dental practices, anybody that wears a white coat or as a professional who wears a tie, right? It happens a lot, but it also happens in the trades where you have apprentices, right? And the electrical contractors, roofers, anybody who holds a license, and you want to promote from within, and you want those people to be who want to be helping you for the next generation of licensed people. So that's kind of how you work in tandem. So for instance, in a particular scenario, you can have a purchase price of 1.2 million, and you say you need the cash to close is going to be 400,000 with a seller note of 500,000 and a forgivable portion of that for 200,000, and a clawback trigger of revenue if revenue dips below 1.5 million. Their adjusted remaining note will go down by 20% exactly. So if you have a half seller note with a forgivable portion of 200,000, and there's going to be a trigger, and it can't be gray. It has to be black and white. It has to be so painstakingly obvious. It has to be looked upon by your attorney. It has to be looked upon by the seller, signed off by you, signed up by your M&A advisor. And I usually act as an M&A advisor in a lot of these transactions, because that's what we do inside of our community. You get multiple set of eyeballs looking and talking about this where it makes sense. And in the cases where we're in our community talking about protecting the buyers, really we're heavily vested in protecting the buyer. If I'm representing the seller, I will be representing the seller and protecting the seller. So anyway, hope that helps you guys. And there's just another tool in your toolbox to get deals done. For a limited time, I'm giving away our Cash Flow Calculator 2.0 and our Business Buyers Checklist. These two documents, believe it or not, people pay for. We actually use them inside of our group. The devil is in the detail and understanding what you're really looking at. But I provide a lot of guidance inside of my free videos here in this channel on how do you actually use the deal flow calculator and the cash flow calculator, So I'm giving them away for a limited time. Click on the links below and yours to have.